Welcome, I'm Catherine Magana here with Steve Wolf and Rachel Ivanovich, where we're here to provide you some insights on the markets, planning, and investing. So here we are, it's June 13th, and yesterday the Fed met and reported that they didn't raise rates, which we're not surprised. That was actually something we finally figured out over the last couple months. And now there's talk that potentially there might be a cut coming in September, but I'm not going to hold my breath because anything can happen between now and then. But I did take a look at kind of to see where the interest rates have been. It looks like the core inflation number annually, it's at about 3.4%. And so I was kind of curious to see where have we been the last few years. It looks like over the last 14 and a half years, 10 out of the 14 and a half years, it was less than 2%. But the last few years, so in 2023 was 4.1, 2022 was 8%, which was outrageously high, and then 2021 was 4.7. But prior to that, we had a long period of time that we had low inflation rates. And so it seems like the Fed wants to get back to those low rates. I definitely feel like it's going to take a little bit of time to get there, but obviously we're on standby as every month and every moment hearing what's going to come next.
We've been talking about rates forever, but an interesting development was that in Europe, the European Central Bank did cut rates over this past week. So there is some hope in our area that maybe our Fed is going to cut rates also, but they don't seem to be willing to do that just yet. As a matter of fact, in the U.S., the Consumer Price Index for May showed a year-over-year increase of about 3.3%, and they're still waiting to get to that magic 2% figure. So I don't think, at least at the moment, there's going to be a rate cut. But I will say that economic activity does seem to be slowing a little bit. So sooner or later, if it keeps slowing, it's funny, we're rooting for the economy to do poorly, it seems like, so that we can get rates down. I'm not sure which side of the coin is better.
Well, when you're talking about rates, I want to talk about tax rates because everybody...
Do we have to?
Oh, no.
I know nobody wants to talk about their taxes, but I'm having a lot of people pay their estimated payments right now because they're due on Monday, June 17th. But it's really interesting to look at taxes in their historical context because people think, wow, I'm in such a high tax bracket. But historically, if you actually go back to the First and Second World Wars, the interest rates, not the interest rates, but the tax rates were as high as 90% at the end of the Second World War.
I don't think I can handle that.
Isn't that crazy to think about? But I really do think that because rates are, I guess, historically low, looking at the top rate of 37% for IRS rates, it might be a good time to think about Roth conversions, because a lot of people have their money in tax deferred accounts.
And that's case by case. We just met with a client this week, and they were asking about Roth conversions, and we went and looked at their tax return, we looked at their investments, and we ran some projections. Based on their age and where they're at, we decided not to go down that path. They didn't have much they could do the conversion with, but definitely it makes sense in some cases. It's just case by case.
It is absolutely case by case and year by year.
Yeah.
You can't really take these things out of context, though.
Correct.
When you had 90% tax rates, you had a gazillion different things that would get you out of paying taxes. And all those, quote, loopholes have now been closed when they lowered the interest rates. That was one of the great things that Reagan did. He really lowered the interest rates a lot.
That's absolutely true. It said about 1982. In the 80s, they started bringing those down. And they passed the passive activity loss limitation rules.
And I'm sure everyone knows what that is. So what is that?
So what that is the loopholes that you just spoke of were certain things like residential rentals. So investors would buy rental properties and or other passive investments. So income has different character. So for instance, interest income is considered ordinary income. Wages is also considered ordinary income. What that means is it's taxed at whatever your marginal rate is. So that's the quote unquote tax bracket that you're in. There is other income, such as capital gain income, but then there's also passive income. So you have to look at, not all income is created equal. So passive income, before the passive loss limitation rules were passed, you could use that passive income from rental properties or other passive investments where basically you're not participating in the making of the money. And you could use those losses to offset your wages or your interest or other things. And so investors would generate these huge passive losses to offset other income and then pay no taxes.
Well, I know that you say that we're paying less as far as the tax bracket is concerned, but the amount of money collected by the IRS is at a record high.
I'll tell you what, when I call people and tell them how much they have to pay, I can't even believe that we have debt.
Right, because you got to remember, too, it's a percentage of what we make. And, of course, wages have gone up tremendously since the end of World War I and II.
That is absolutely true.
You know, I think my parents bought their house. It's for $60,000, which today that same house is probably $800 or $1 million right now.
Yeah.
So, you know, the rates themselves don't necessarily tell the story as far as taxes are concerned. And speaking of taxes, here in San Diego County and a few other places, they extended the deadline until actually June 17th this year from
Correct.
April. And you were telling me that some of the other states,
There's several other areas of the U.S.
because
that
of the
also have-
disasters
Correct.
that have happened. So interestingly, I started looking as far as, you know, taxes are concerned, since this is our time for the deadline. And the IRS is saying that there's a lot of scams going on, especially aimed towards seniors.
Yes.
And some of the scams typically involve people who are posing as IRS officials, and they're contacting seniors via phone, email, text, etc. And often they're using threats of false or false promises to extract personal information from people. So if someone's asking you to pay your debt in a gift card or something like that, please, red flags should be flying.
Do not do that.
Okay. But they're using some sophisticated methods such as spoofing caller IDs, so that it makes it seem like they're calling
Yes.
from the IRS, and they're not really. So, you know, when you start getting calls, or especially emails and text, the IRS will not do that.
I
Correct?
was
will
gonna say, I've
never-
been getting
no.
phone calls like on cell phone and text, and I'm like, I don't owe money. Like, I'm up to date on everything. Like, where are you getting my number from? It's
The
just
the
odd.
IRS will never call you and ask for money or ask for information over the phone. You will receive a notice in the mail, and if they're really serious, it'll be a certified letter.
Right. And so if you get something like that and you're just not sure, hang up the phone, call the IRS yourself and say, you know, is this something that I should be worried about, you know, especially if they're making threats of imprisonment or who knows
Correct.
what.
And don't use the number they provide you, right?
You can call 800-829-1040, and you may wait on hold.
course you know the
Of
number.
course I know the number. I've called it a million times. You may wait on hold for a very long time, but I would say absolutely, as Steve suggested, reach out to them directly. They will not call over the phone. You will receive a notice if there is something wrong.
Okay. So go ahead.
I was going to just say the suggestion is if you do receive those phone calls, there is a website that you can go to report the scam call. It's the Treasury General's. I would just Google IRS scam phone calls, and it will pull it right up to the top. You can go there and you can report the information. The other thing is if you suspect that your information has been compromised with your Social Security number, you can apply for an ID PIN. The IRS has a form where you fill it out, you provide a couple of pieces of identification, and they will mail you a new PIN every single year, so that you can use that to e-file your returns. Because oftentimes what I've found is a client will come and will do their return, will e-file, it'll reject saying someone's already filed using their information. And therefore, from then on, pretty much you will need to provide that PIN in order to file.
Okay. So now let's see if we can get back to some more interesting topics like stocks and
Come on, Steve, I love taxes.
I know you do. So tech stocks continue to advance. That seems to be what's moving the market the most. When you look at the S&P 500 or the NASDAQ, whatever, I mean, it's the tech stocks that
As I
are
say, the S&P is pretty much almost at its high. It looks,
correct.
Yeah.
Well, it is at its high,
Yeah.
at least
Close.
before this morning. And the other thing that's interesting, though, is there are a lot of stock splits that are starting to come back in vogue. For a long time, it was the Warren Buffett approach that I'm not going to split my stock and I'm going to let it go to $1 million a share or something like that. But what's interestingly, you know, why are the splits happening? These companies are realizing that their employees can't buy the stocks when they're $5,000 a share. So there's been splits 4-to-1, 10-to-1, even 50-to-1.
Wow.
There was one company that did 50-to-1 because they said their stock is so high, their employees just can't even buy one share. So it's really interesting how kind of things are so cyclical.
Yeah.
There are times when it seems like the whole market, all the companies all want to do is contract and buy one another. And then there's other times when all they want to do is spin things off. So everything is cyclical. But it's tech stocks still that we're watching and it continues to do well. Look, AI is here and it's not going to go away. It's being used in more and more and more applications. So that's a part of the market that definitely you want to be in. I think that the other parts of the market aren't doing nearly as well. Everyone was touting energy, and all of a sudden energy is now down a lot. I've noticed the gas prices around here, which are still high, but they've come down from, even at Costco, from like $5.10 a gallon to maybe about $4.30 a gallon, which is a pretty good sized drop. Our energy stocks great. I don't know. You never know what stock is going to be good over a short period of time. But you know what? When you're looking to invest, don't look at the very short term. Look at, do they have earnings that will continue to grow? And I've said this in a million of these podcasts, but earnings growth is really what you should be looking at.
And then obviously interest rates, they're on the short term are still pretty attractive. And that's the hard part is, obviously it's that those are where the rates are right now, but it's not going to stay that way forever. So just make
unattractive.
I'm sorry, unattractive, right? Or no, interest rates are attractive for fixed income, short-term fixed income buyers. So those that have some cash on the side, if they're not doing a money market, they might buy some treasuries or CDs. But eventually, that's not going to last. So on the short term, it's okay, but long term, it's not we don't think it's the best place.
But you know what? When you say interest rates are attractive, just remember that the higher interest rates go means the higher inflation has gone.
Yeah.
So yes, for the fixed income investor, as long as he's not eating or putting gas in his car, he's doing fine.
And usually it's the opposite. Usually we see money marketing these rates lower than inflation, but at this point, it is, they're doing a little better.
Well, if inflation continues or goes at its average, which it probably never does, but the average was somewhere between 3% and 4%. And you can get a fixed income that's at 6 or 7%. Again, providing that you're not impacted tremendously by what is being inflated the most. And unfortunately, right now, it really is food. Yeah. Food has just gone skyrocketing. So maybe, if the oil prices go down and gas and that goes down in price, that will help offset some of the costs because part of it is transportation, getting it from one place to another. The other part, of course, is labor. The cost of labor is going up. So, and I've said this before, you can raise minimum wages all you want, and all you're really going to do is increase the price of the good or service being sold.
Yeah. And we're starting now to see some companies restructure, and obviously they're trying to price all this in, and there's obviously the impact from that too. So as we wrap up, I wanted to share a planning. We've talked about in the past, but more of a planning tip was making sure your beneficiaries are up to date. We recently had a new client that we are working with, and we come to find out the primary beneficiary was a spouse that passed away. So we worked on getting that updated. But during this last few weeks, I actually came across a Wall Street Journal article that talked about there was an employee from a big company where he started working there in 1987, had a girlfriend, put his girlfriend's name down as a beneficiary, and it was a handwritten beneficiary. And then he ended up getting ill and passed away, and the ex-girlfriend is still the beneficiary, and it's almost now over $1 million of this retirement asset. And the family, the brothers, everyone's like blown away, like what happened? And once again, those beneficiary forms, those are documents that are, that
legally binding.
It's like,
gosh.
And so I thought that was interesting because we see things, but here we are. There are instances, where it's really, really important that you are looking at your beneficiaries, and if you signed something up a long time ago, or did you not put one in place and with your employer, and so it's really, really important.
So the girlfriend got the money.
Well, they're in litigation right now, but it looks like based on the documents that that's what's in place.
In my next life, that's my financial plan. I'm going to marry somebody a lot older and become the beneficiary. Somebody who's really wealthy. All right. Well, thanks a lot for listening, and we'll see you guys again next week.
Thanks.
Please stay tuned for important regulatory disclosures. WWM Financial is an SEC-registered investment advisor. The opinions expressed in this program are for general informational purposes only. and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry and how we may be able to assist. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. As always, please remember, investing involves risk and possible loss of principal capital. Tax considerations presented may not be appropriate for every individual circumstance. A tax professional should be consulted before making any decisions about your tax liability.